Welcome. It is Thursday, August 4th, and welcome to another episode of Bitcoin Magazine Live. It is I, your host Q, coming to you straight out of Nashville at Bitcoin Magazine HQ. Yes, I'm wearing my sunglasses. I left my mother's basement and I went full douchebag, and I'm joined by my co-host P. How goes it, P? You're muted.
Fuck. Sun's out, guns out is what I was saying. Yep, I felt I wanted to sort of be in solidarity with you. I put on my sunglasses as well. Not sure how far I'm going to make it because I can't see shit. I'm like hitting stuff, knocking it over. But yeah, we got some great news stories today. And then we've got James Lavish, who we are super fucking excited to be talking to.
Yeah, I might fangirl out on that. And then, of course, we're joined by none other than Jimmy Saw. I appreciate my cohorts here joining me in solidarity. My eye literally just decided to stop working and the contacts hurt my eyes too much. So needed to wear the sunglasses. It is what it is. It's a mirror shade day kind of day. So jam-packed episode. Let's dive right into it with some news and notes. Marky McZuckbot, also known as Mark Zuckerberg, announced that they are rolling out digital collectibles at Meta to 100 or more countries. Now, more people, creators, and businesses can showcase their hashtag NFTs on Instagram. My response to that is a big fat.
That was the worst fart I've ever heard.
I don't give a fuck. Sorry, I know we're supposed to stop cursing, but like this is just like the grifters that continue to grift. This coming to you from the same company that has two failed ICOs, a failed digital wallet, and a host of other just deplorable acts is now telling you, hey, give us your scammy little NFTs and we got you, man. You can be all like cool with your NFT and your profile picture. Tell you what, if I get an alert from any of my friends that have now posted their NFT as their profile picture, I'm immediately going to go and screenshot it. I'm just letting you know, full warning. I will screenshot your NFT profile pic.
What if my NFT profile pic is a picture of you, Q, with the sunglasses on?
I'm still like,
he didn't say he was going to do anything.
I'm just going to right click.
He's going to go. He's going to take it. It's going to go into the Spank Bank, and then.
Here's the truth. I feel like, and I say this as someone who like has no real understanding or knowledge of actually the security or safety of an NFT. But I would think that if Facebook wanted to roll this system out, no different than the way they did with Instagram or the way we've seen with Twitter, there would be some sort of security measure that would prevent you from just right clicking and saving. But I also feel like this technology is just so stupid and being ill used, and you'd be ill advised to be excited about this, in my opinion.
So I have not yet dived super deep into this, but I want to be clear that when we're talking about NFTs, all an NFT is like a timestamp and a hash. And most NFTs, they contain a little JSON blob that links to some other URL where an image of this thing or more information is held. And people conflate like the image that is associated with that NFT with the NFT, which is just, again, a timestamp and a hash somewhere on a blockchain. And so the argument that people make of like, oh, right click save, it's like, it's actually kind of a spurious argument, although it is understandable since the frame that is put forward by most people that are promoting NFTs is that like it's like digital provenance. You're somehow like owning this magical image. And again, all it is like a provable link to someone's specific wallet and a timestamp. And that's kind of it. So, you know, NFTs have been around for a long time. They were originally implemented on Bitcoin. There's a system called Counterparty. And I can understand why someone would want to be able to say like this famous or this well-known person created this asset and then they transferred it to me. But I do not understand the obsession with the images or all this other stuff that goes around with them. And I think most of it is just, as you were sort of drawing attention to, Q, it's just being used and promoted because people are excited about it. It's the new hot thing. And so by like your platform, you can just bring in a ton more people. At the same time, it's like, shit, if people want to lose money doing random crap, they totally can. Fucking go for it. I think Facebook is, you know, it seems like it's a dying breed to your point, and who the fuck knows what'll happen next. But I mean, Twitter just did the same thing. Whenever you change your profile pic, it's like, do you want to put an NFT there? And it's like, hey, people want to do that. Who the fuck cares? In my opinion.
Spend your money on whatever, do it. Just do yourself a favor and stop buying Gary V's fucking 100%. NFTs, because the man is rich enough and doesn't need to grift on you people, except for the fact that he's probably not as rich as he claims.
Yeah. I do want to be clear. People that are promoting NFTs are, I mean, like, it's just yet another way for people. It's just yet another way for people to take Bitcoin out of other people's pockets and slide it right into theirs. It's like 9 times out of 10. But let's move on. What is the next story?
It's your story.
Ah, shit. All right. So there is something that got posted to Twitter recently. The source of the Solana exploit that we were talking about yesterday appears to be linked to a specific wallet called Slope that, I can't even say this with a straight face. They were allegedly storing private keys in plain text on their centralized server. And if you're a software engineer, this is like encryption 101. You never fucking store passwords or important information in plain text in a database. Like, why would you ever do it? You just hash that shit and then it's more secure. They didn't do that, and apparently they got hacked, and then that centralized database, that centralized information was distributed, and apparently all these people lost all their fucking money. It just goes to show you play stupid games, you win stupid prizes.
Yeah, that's a real shame too. I mean, I think, Pete, to your point, it's like, this is database 101. I bet the hackers got in. They're like, oh, like maybe it's behind some like encrypted firewall, or like, I got to go in there to hack it, figure out more. They're just like, oh, it's in plain text here. And they just like copy paste and they start like mass restoring everyone's seeds and sending it to their wallet. So it's a real shame. But yeah, I mean, that's the bummer of it all. Speaking of the next shitcoin on the list, Coinbase's stock shot up 14% on the day and 53% in the last 5 days, causing it to be briefly halted for volatility for a few minutes. So literally for like 6 minutes, you can no longer trade the stock ticker coin. By the way, this is not financial advice. We do not, give trade advice. This is, you do your own due diligence. But yeah, Coinbase's stock was halted. And this also comes 5 days after Cathie Wood actually unloaded all her bags of Coinbase. So, after riding down the volatility of like 80%, whatever it fell, like some absurd percent, it flails up an additional 53% in the last 5 days after she has already sold it. So
that has got to sting.
Yes, for sure. Q, you want to hit up the next story?
Yeah, I'm also going to just put a poll into the chat box because I feel like being a degen. Shout out to everyone posting the ridiculous comments. Keep it coming. You guys are cracking us up. CME Group to launch a euro-denominated Bitcoin and Ethereum. Sorry. Futures on August 29th. I mean, cool. Bitcoin's going to keep mining a new block every 10 minutes. Doesn't matter if we have another futures-oriented ETF or if we have a legit ETF. Doesn't fucking matter. I don't care. I just don't.
Well, but this is a futures product, though, not an ETF, correct?
Correct.
Okay, got it.
So it's like you're betting on, do you think the price of Bitcoin will go up or down within a certain predetermined period of time, which honestly to me just sounds like you're inevitably short Bitcoin, because if you think it's going to go up, you are far better off just actually using that amount of money you would have invested in this vehicle and buying the actual sats yourself. The only actual viable thing for something like this is if, for whatever reason, you want to short, mind you, no financial advice. I literally live in my mother's basement. You should not be taking financial advice from me. You should do your own due diligence. But if you're a jackass and actually want to short the price of Bitcoin, that's the only legitimate reason I think this is viable. Well, otherwise, I mean, you're better off owning the sats. If you think it's going to go up,
I mean, I agree with you.
That's what I'm saying. Like,
okay,
if you
now your keys, now your coin
go down, and you want to capitalize on that movement, that is the only reason, in my opinion, to use this vehicle. Otherwise, you might as well just buy the sats and hold the keys in your own cold storage wallet.
Yeah, I agree. If you are also trading with leverage is a terrible idea, and you're going to get wrecked. So If you think Bitcoin's going to go up, you're going to be way better off just managing your cash flow, buying Bitcoin, taking it off an exchange when you're ready to do so, and storing it safely. Don't use leverage, kids. Also, as somebody pointed out in the chat, these markets are super illiquid. You get like the spread is just fucking awful on this kind of stuff. I don't know what it is off the top of my head right now, but yeah, piece of news. TikTok next block. What else have we got? So BlackRock announced today that they are partnering with Coinbase to be able to offer their plethora of crypto assets to BlackRock's clients. This is super interesting. There's a lot of opinions about this. BlackRock is fucking huge. Anyone know off the top of their head what their AUM is?
Yeah, it's 9.8 trillion assets under management.
That's low. It's lower now. They had their worst ever.
I didn't see their new filing, but yeah, it was like
their
9.
new filing.
Let's just say 9 trillion assets.
It's
under
8.4. It's 8.4 because they had 10 and they just got rocked and lost 1.6, and that's the largest loss BlackRock ever had. But like it was this whole thing that Larry Fink got into in the earnings call where he was like, "We on paper we have lost the most amount of dollar amount in the history of BlackRock in one quarter." But when you extrapolate that out and realize that's because we also had the most ever money under management or assets under management in the history of BlackRock, you kind of like, if you base it off percentages, their sell-off was like 17% sell-off, which actually beat the general market sell-off. So, but they had the worst quarter ever in the history of BlackRock. So just more context there. But please continue.
Okay, so I want to give some important notes here. It appears as though this is going to be not just Bitcoin. It's going to give you access to all the other shitcoins as well.
I'll caveat this. So I actually asked our news team to clarify on this. It's Bitcoin only, but then they put a caveat. Depending on client demand, we will potentially offer other assets. So right now they are Bitcoin only, but with the caveat that everyone suspects they're going to offer other things. So
that is actually interesting, though. I mean, that is, I think that's a positive piece of information. I would have expected them to go the other way, although maybe they're doing Bitcoin only because we're in this bear market and everything else has just gotten totally wrecked. But I think that's a positive thing rather than just trying to.
Yeah, and as much as we shit on like the institutional investors, they are, as much as we call them idiots and things that they do, and the heinous things that they've done in the past, I do think they're smart that they wouldn't just be like, when you start mixing in other things that are potentially securities. Like their lawyers probably looked over this. They're like, hey, like we can't get into this until we get clarification from the SEC or the CFTC, where Bitcoin has kind of been grandfathered in through other rulings. So I think that their lawyers are like, we do not want to touch this. If you want to go Bitcoin only, we can work around that.
So there are two important details here. One, this is only available to their institutional clients as of right now, or when they release it. The other thing is that you're not going to be able to buy Bitcoin through them and then transfer it off the exchange. So it's going to be like it's going to be paper Bitcoin, right? So we love to say, not your keys, not your coin. So that's something that irks me personally. And it should irk you too. But this still is important in my mind because it does provide access to Bitcoin for a massive number of institutional clients that already have access to it as of right now, but it helps to legitimize Bitcoin for these people in a way that contributes, in my mind, to hyper-Bitcoinization. Now, the other side of that, of course, is that this is a centralized system. It's paper Bitcoin. You can't take it off the exchange, but I still think that the more legitimacy we can give to Bitcoin, the better off we are overall. And I think it's on all of us to continue to educate people about the importance of maintaining your own sovereignty and taking control of your financial future by owning your own keys. What do you guys think?
Shit coin's gonna shit.
I don't even know what that means.
I mean, ultimately, this reads to me more like Andreessen Horowitz and all of the other VC firms that kind of have a pulse and a phone line entry with someone like Larry Fink, getting to further entrench their own pockets and their own interests. Because if BlackRock gave a shit about Bitcoin, they understood Bitcoin, you wouldn't have done this partnership with Coinbase. You would have reached out to someone like Jack Dorsey. You would have reached out to someone like Jack Mallers. You would have even reached out to Swan, for Christ's sake. But their priority is not Bitcoin. Their priority is to make up the $1.6 trillion they just lost. And for that reason, they are going to focus on what is going to make us as much money as possible. That's going to be, let's do the whole fucking casino. Get as many of these fucking bullshit products as we can.
I don't agree. I think that they're at the scale that they are operating, there is a very, very limited number of entities that can handle these, just the volume that they are expecting to do here. Obviously, they're only opening up to their institutional clients. I don't know how many there are, and I don't know how much they're expecting to, have these people transact. But, for regulatory reasons, for insurance reasons, I think that there's a small number of people that they could do this with. I'm sure that there's more than just Coinbase, but they couldn't go to like a Swan Bitcoin as much as we love them and get it to work.
Yeah, I think I'm going to echo kind of what P is saying. Like, really, I think the only two people that they could do that I know of right now are either Coinbase or NYDIG, and NYDIG has been doing a ton of work with a bunch of different companies. But yeah, exactly to P's point, like the reason, like a BlackRock couldn't go into a Swan Bitcoin because not that they would move the market, but it just, they basically take over the company by taking a whole lot of money and moving it through Swan. So it's like, I think Coinbase is a publicly traded company. It has more money flowing into it. It's exactly, Greg Foss was explaining this morning on Spaces, that like the reason Apple, Microsoft, like all of these big, Google, the gambit of companies in the FANG stocks, that BlackRock loves these companies because it's easy for them to move money in and out of those positions. Where like if you go to something that's a much smaller, sub $100 million company, they would basically, like, them just putting in $10 million moves the market by 10% upward. And like there's like slippage and all this issues that comes in where you have like much larger institutions.
Well, also
that do it.
Like Swan, if you're buying Bitcoin through Swan, it's being custodied by a third party, Prime Trust. So Coinbase is its own, they have their own custodial arm. And so that's another part of it. Like, they have all these APIs. It's, quote unquote, battle tested. So there's a lot of reasons why they would have to do it there.
Just saying. There's also another caveat to this that I think is really important. So this, I don't know how into the weeds we've gotten to it. If you guys have already kind of highlighted this, my bad. This is specific to BlackRock's institutional investors. So that means this is going to be for their banks and banking clients. So what this really reads like to me is this is a response to the Fidelity move earlier this year, where Fidelity offered its 401k clients the opportunity to invest in Bitcoin exclusively. But now you have banks that are partners with BlackRock with the opportunity to offer their clients not only Bitcoin, but every other crypto asset under the moon. So like you and I are not going to deal with BlackRock if we were to go down this path with them or use this venture for whatever reason we may want. It would be like one of BlackRock's partners. And again, this is just to further validate that because Fidelity made the first move in this space, now all the other competitors in that space have to respond in some way, shape, or form. So my hat goes off to Fidelity for at least leading the charge. And we'll just continue to see more of this. This is a developing story. I'm sure other banks are going to look into ways to further incorporate Bitcoin in the broader crypto market. Say what you want about crypto, say what you want about the rest of it. All press is good press for Bitcoin. Yes, it'll confuse a lot of people. Yes, people will get lost and go down the wrong paths. Ultimately, though, all press is good press for Bitcoin.
Yeah, and I'm going to echo that, Q. I think that's a good point. I think it's only a matter of time before Vanguard's right behind. If you think of the big three, at least in the United States, it's BlackRock, Fidelity, and Vanguard. I wouldn't be surprised if in the next couple of months we see Vanguard come up with, I don't want to say like an index fund, but that's kind of what they're known for, like low-cost index funds. But if they come up with, a way of self-custodying for their institutional clients, Bitcoin for the time being, and then hopefully try and build up an index fund. Maybe that's in line with an ETF. So that might take some time, but I can see it opening up for their institutional clients as well. I guess.
Wait, hang on. How much of this do you guys think is like there is a conversation happening behind closed doors in this vein or around this topic that also includes things around the Bitcoin ETF that is yet to be approved. You also have, Jamie Dimon kind of weirdly hating Bitcoin, but secretly like wanting to have the biggest Bitcoin stack, and his micro penis getting in the way of JP Morgan just aping in. And ultimately, I don't believe that Gary Gensler is sitting there being like, oh yeah, my banking buddies over here are good to like do whatever they want in the Bitcoin space. But you as an individual investor can't invest in a Bitcoin ETF because like, you don't know the risks of that. Like, are you kidding me? I know more about Bitcoin than Larry Fink, and I barely know anything about Bitcoin. So why is it that Larry Fink is the person, or whoever at BlackRock, realistically not Larry Fink, but someone at BlackRock is going to be sort of the de facto person leading the charge in this crypto space, when in fact it should just be individuals being given the opportunity to invest in whatever vehicle they deem is the best for their investment portfolio. So I don't know, maybe I'm a little too tinfoil hatty here, but how much of this is let's keep as much control over the financial markets in the hands of these select few people, the banks and these banking entities, versus let's open the floodgates to Grayscale having a Bitcoin ETF and anyone being able to now just go into it and buy it. Because like, you can't just buy a BlackRock fund, can you? Can I just go on I don't know. I don't buy BlackRock shit. BlackRock's stupid.
I have no idea. That argument doesn't make sense to me. I think that
why is Gary, let me rephrase. Why is Gary Gensler okay with this, but not okay with a Bitcoin ETF?
Well, Gary Gensler doesn't approve this, right? Like, what does Gary Gensler have to do with BlackRock?
He regulates securities, which BlackRock is. So
yeah, but he doesn't have the ability to say BlackRock can't partner with, like, can't offer a new.
I completely disagree. If Gary Gensler wanted to step in and say you can't do this, Gary Gensler could have stepped in and said you can't do this.
But he'd have to have a basis for that.
Yeah, okay. Thank you, Hammersoft, for pointing that out. I was like, I'm pretty sure I can't actually go buy on E-Trade like a BlackRock fund.
You could buy BlackRock, the stock itself, too.
Wait,
which would be terrible.
What are we talking about?
Not investment advice.
I feel like you like hold that up like a talisman. Like anytime you say anything, like
I'm just gonna put a whiteboard.
You ever eat human meat? It's good for you. Not investment advice.
Whiteboard. Do not invest off of what I say.
Just get it tattooed on your forehead. Yeah, I don't know, man. I think you're reaching for straws. You got that tinfoil hat, like firmly everything. I mean, yes, the government people are trying to maintain power structures, but I don't think there's like some vast conspiracy on why like an ETF has not been approved and this is like soft approved. I still am not convinced that like Gary Gensler would have any ability to block this. Like I don't know what lever he would try to pull or what argument he would make. Nor I don't understand why he would want to. I think people are doing exactly what serves their own best interest here, and I think it's primarily just BlackRock and Coinbase. But who the fuck knows?
Yeah. I guess I'll caveat this. I was on Twitter Spaces this morning, and a bunch of Bitcoin plebs, were pretty upset about the news of this. And I know we always say like Bitcoin is for enemies, meaning that, if I don't like P for whatever reason, I mean, he's a 100-year-old man. He's a sweet, loving old man that I don't know why you'd hate him. He's a nice dude. But anyway, let's just say I were to hate him. I can
give you reasons.
Let's just say I were to hate him. I mean, there's nothing I could do to stop him from transacting Bitcoin. That's kind of the censorship-resistant nature of it. Barring holding a gun to someone's head, but that's the morality of it is a little different. But basically, the nuance that they were trying to say is they're mad that institutions are getting in because the people that really need this are the middle class, which is diminishing, and the poor people. I understand that a lot of them can't put millions or billions of dollars into this, but even just putting small incremental amounts, $10 a week, taking a little bit of the paycheck that they do have and investing it into it. So they were looking at it from the flip side of like Bitcoin's price is down, but this is a great time for people that are less fortunate as they get hammered with inflation, as they get hammered with, all the different food prices going up, gas going up, housing prices going up, rent going up, all those different things. This would be a good point to start allocating some of their money to Bitcoin. And they say with institutions coming in, it's only a matter of time before the price goes up and they're going to be, they don't want to say controlling the supply, but making it more difficult. They brought one last thing. Go ahead, B.
No, I was going to say, like, I understand that, but I don't feel like people were sad or upset when, Elon Musk initially announced that he was going to, put a bunch of the treasury from Tesla into Bitcoin. Everybody was like, yeah, let's fucking go. Bull market. Let's do this. And so I actually think the larger issue here is though I empathize with those points and I think they are valid. I also don't think that I will be very interested to see like how much money actually flows into Bitcoin because of this in the short term. The larger issue, as I see it, is the centralization issue, which we kind of referenced a second ago, which is like if depending on how much BlackRock's clients are custodying with Coinbase, it further centralizes, and you can't even take it off of the platform as we were talking about. That is a significant issue in my mind, or it is a potentially significant issue.
Yeah, and I guess I'll caveat that with the other point they were saying, aside from making it more difficult for plebs to get into it, and maybe it's bull market versus bear market mentality. Bull market, they're like, price keeps going up, let's keep going like a rocket ship. Now that price is down, they're like, no, we don't want price going up anymore. We're good at the bottom dwelling here where we can pick up cheap sats. I don't know if it's a mentality thing. I think not that people trust Elon Musk, because don't trust verify, and look where that got us with Elon, myself included. It was like wildly bullish and they sold off a bunch of it. But I think the point goes here is that they're worrying about, and this was one of their key points. Like to Q's point, they're partnering with Coinbase, which is a shitcoin casino. So what is it like? Oh, guys, we're all out of Bitcoin. We've custodied it all. We bought it all off Coinbase. They have no more, but we're going to offer you BlackRock crypto token or whatever it may be, like whether that's a form of their stock or whatever. But yeah, like they start pushing other things. Or to B's point, that like, hey, BlackRock, I'd like to like get Bitcoin in my own wallet. No. It's safer with us. We can give you something else. Like they worry about like the centralizing force of it all. I don't know if you guys have anything to add there.
I think you said it. I think they're valid points. I just don't know if I personally am not like, oh, this shouldn't be happening. It is a bad thing overall. I think it is, as I said, I always want people to be moving towards custodying their own Bitcoin. And I think that it needs to be in the hands of as many people, as many individuals, as many communities, smaller communities as possible, rather than like adopted by the traditional financial system. I think that is a potential attack vector on Bitcoin overall. But, and I think the more people that own, quote unquote, own paper Bitcoin, it's not good ultimately for the strength of the network overall. But I think those problems existed before, the day before this announcement. They exist now. And I think the solution is for all of us to continue to support the development of more private, more decentralized systems within Bitcoin. We talked about Stratum V2, which is, improves the decentralization of Bitcoin mining. I think that there's just, it's just part of the process. We got to support those things, support education. We'll get there eventually.
Yeah. I guess one last thing. So it's very interesting. And this is kind of saying like all roads lead to Bitcoin and everyone capitulates eventually. So back in 2017, Larry Fink was famous for calling Bitcoin an index of money laundering. So basically, 5 short years ago, he was calling Bitcoin money laundering, or what like criminals use. And now he's offering it to institutional clients. So just kind of a funny caveat for sure, that like how things have changed in just 5 short years when you really think about it. I think that's all we got. I guess, is there anything else you guys want to riff on?
Yes. Another interesting thing that came out today is the full list of companies and organizations that Celsius owes money to was released. And there are some fucking doozies in this list. This was reported by No Bullshit Bitcoin, a fantastic source of Bitcoin news. Everyone should be subscribed to that. They have a Telegram channel, and it just gets posted as it comes out. It's one of my go-to sources. Anyway, they have the actual document. You can skim through it. It's very, very long. But some of the ones that stood out to me, again, these are people that Celsius owes money to. AT&T, 1-800-Flowers right at the top of the list. The California Attorney General, Deloitte, Dow Jones and Company, Facebook, BP, Google, IKEA, Pizza Hut. There's a whole laundry list of them, and it is just incredible. None of these people are going to get their money back.
What is your favorite? Like, what is a company where you're like, LOL, fuck you?
I don't know. The fact that they owe money to the California Attorney General is very interesting to me.
Like, as an individual or as like the state of California? Because I need to better understand where my tax dollars are going.
Well, these aren't your tax dollars. This would be But
if the Attorney General is funneling money from his office as an investment vehicle into Celsius, then yes, these were my tax dollars, and probably yours too.
that's a great fucking question. I believe it is the office of the Attorney General. I need to go look. Wait. I need to verify that. We should go look it up after the show. There's also like a gazillion just people that are just like confidential. So
that is wild. We're going to have to unpack this. I'm getting really angry. But before we go to a commercial, I want to remind everyone, lock in your tickets to Bitcoin Amsterdam. Ticket prices will be going up, I believe, in another week. Use promo code BMLive. Get 10% off of your tickets. Do it for the kids. We are the kids. Please do it for the children.
That's right. Don't forget to like, follow, subscribe. This channel,
That too.
all of us, get your Bitcoin news, get your Bitcoin shit. We will be back soon for our next segment.
Stick around. Thank you for sticking through those commercial breaks. I'm excited to introduce our guest for today. He's a reformed hedge fund manager, an ex-Yale hockey player, someone that I have learned a great amount from, and that I know a lot of you have learned a ton from. Please welcome James Lavish.
Hey guys, thanks for having me.
Welcome to the show.
Yeah, thank you for having me. Can you hear me okay?
You sound great. You look great.
We're
good to go.
You don't have to lie.
No, you do. Like the framing is nice. You got like a background we can like see depth in, but then your face is nice and sharp. It's a good look.
To be honest, you're making it look bad for me because my setup when I'm not in Nashville is far worse than yours. So
it's easy. Just get a camera that you have a pretty good lens on. Put a 35 millimeter on it. You're good.
What is this?
And then you got to have a background. That's Keith's problem.
The background is my problem, less the camera.
He lives in a cardboard box, and then there's like a single sheet of drywall that he pretends he lives in his mother's basement. But
this is true. Well, whenever I piss my mom off, she sends me outside, and I sleep in a cardboard box.
This is we have more in common than you know. So this is not my house actually. My wife and I evacuated Vegas for most of the summer, so I'm here in California for a couple more weeks. I've been here for 6 weeks, and so it's a pretty nice rental though.
Nice.
It's a good place, yeah.
So James, what did I miss in in introducing you? I know you call yourself a reformed hedge fund manager. What would you use to describe yourself?
No, that's pretty good. I would say that I come from the traditional investment world, and reformed means I've dug into Bitcoin deep enough and understand it enough to understand just how important it is and how broken our system is. And, I benefited for many years in that system, and so the Reformation is understanding how damaging this system is and how it's creating a separation of wealth in the Western hemisphere. So it's an incredibly important change in my life, and this is where I want to be to help educate people and kind of bridge that chasm between institutional and traditional investing and finance and Bitcoin and the future. And I think that with my experience and knowledge, I know that I've seen some things that people haven't seen. You know, Greg Foss will say you sat in the risk chair, or whatever, you know. I've been in hedge funds and private equity for 25 plus years. And so there are some things that everybody in this space could benefit from. And I hope to help people understand those things.
One of my favorite questions to ask people who come from traditional finance into Bitcoin is, and if you are a better man than I, which I don't doubt for a second, like, what was your initial gut reaction to Bitcoin? Like, mine was, what is this? Like, no, go away. I don't want to buy this to buy weed in college. And what was sort of the value proposition that really cemented what Bitcoin could be for you?
Yeah, that's a good question. So, you know, when I heard Bitcoin, you know, people talk about it kind of on the fringe. Nobody in the traditional world was talking about it. Nobody in traditional investing was talking about it. You know, like my wife's friends were talking about it. Some of the people who were in technology or computers or, you know, that world. And I just ignored it. I dismissed it as, yeah, it's just, you know, it's an online casino. I couldn't wrap my head around it. I didn't do any research on it. So that was back in 2014, 2015, 2016, somewhere in that area. And then it popped back up on my radar. And guys, this is one of the most painful things to admit and realize. But back in 2018, I had a little bit of discretionary capital, and I wanted to put it to work. And I wanted to go out of the risk curve, you know, somewhere outside of the things I was doing that were normal, right? So not my house investment, or not investment in stocks, or not investments in private equity, but something a little bit further on the risk curve. And Bitcoin popped up on my radar, and I was like, I got to check this thing out, because this is not going away. It just run up into the 20,000 plus range, and it come all the way back down under 5,000. I thought, this is someplace where I think that this is real. And the funny thing is being an investor and seeing it run up like that and then come back in, I felt like that was a healthy pullback. And my immediate reaction was, this is a healthy pullback. And this is something that it warrants me taking a look at here. So that's kind of a funny thing, right? So, and then I did as what you do normally when you're an institutional investor. And I went to the so-called experts on the street. And since Bitcoin is technology related, I went to the technology analysts and experts in investing, and those who were you know, deep in that industry and that sector. So, and across the board, they were like, it's not really worth anything. It's a Ponzi scheme. It's just, you know, it has no underlying value. And I dismissed it again, and I just let it go. It's so painful to think about, because, you know, thank you so much, the experts. Thank you so much for warding me off at $3,500. That was so helpful. Thank you. Because, you know, then I could get in back in 2020 and 2021 when it was up in the 40s and 50,000 range. And that's where I could start buying it. So, you know, but the saying goes in our circles, everybody gets the price they deserve. And I deserve that price. I was arrogant, I was ignorant, and I deserve it. And so, but that forced me to dig really deep in and understand it, truly understand it, before I started buying it. And so I didn't buy it on speculation first. I really started digging in on it. And so flash forward, this is a long answer to your question. I'm sorry. And if it becomes a monologue.
No, please. We are loving this.
Okay. So flash forward, and we hit the pandemic, and I'm leaving my situation, and I'm trying to figure out what to do. And my son, who's in college, he said, and he's got a bunch of super intelligent computer science major friends, and they're like, you've got to check out. He said, you've got to check out this crypto again, Dad. I think you ought to give it another chance. And he said, crypto. And so he convinced me to buy some Ethereum and maybe Cardano. And so I started digging into it, and it was within weeks that I was like, okay, I've got to go back into Bitcoin, because that's where the reality is for me. And so, so I started moving all my assets that I accumulated into, well, not all my assets. Let me back up. What I had bought in Ethereum and Cardano, I moved it all over into Bitcoin, and I started digging in. And that's really where I started understanding what it was about. Flash forward a few weeks or maybe a couple of months by then, where I watched all the Michael Saylor videos. I read some books. I'd seen a whole bunch of trading videos on YouTube, and then I stumbled across this this Pump interview with Jeff Booth. And you guys may have heard this before, but Jeff, I sat there I had my laptop and I was on the edge of the bed, and I just started this video. We're about to eat dinner, and it was about 25 minutes into it, and I just stopped and I said, okay, I've got to get my wife to see this. She's got to see this. So I said, Vicky, come here, look at this, watch this. And we sat down on the edge of the bed with my laptop and we watched it all the way through. And at the end of it, she looked at me and she's like, do we own enough? So I watched it again. I really, Jeff he's an important person in this space for me. And I've gotten to know him pretty well, and he's a great guy. But his explanation resonated with me like no other explanation, because I come from the world of institutional investing and an understanding that global macro approach of the deflationary forces of technology versus the inflationary forces of money manipulation in the Fed, and how those are kind of diametrically opposed, and how eventually they'll crash, and they will crash into each other, and there will be hopefully not, but there will be some sort of massive change. Hopefully it's not catastrophic. Hopefully we can kind of run operating systems alongside for a while, but that really that made it click for me. And at that point I was like, okay, that's it. I'm all in on this. I need to just find a way that I can get into this space and help people understand it. And this is where I want to spend my time for the remainder of my career. So that is a long answer. Sorry, guys.
No, it's so interesting. I guess I got a couple questions. One is, it's super interesting to me that it sounds like you made the transition from not understanding what Bitcoin was and sort of the unique aspects of it to understanding it. It sounded like you said like within like a month, like within like 3 to 4 weeks of basically like owning a shit coin and then digging into it and just being like, got it, and switching over. That's a remarkable turnaround.
Well, I mean, remember I had seen it before. And so I knew a couple of the properties, but then I really dug in and understanding how it's immutable, understanding how it's truly decentralized, understanding how there's a limit to the number that will ever be mined, how it's trustless. Like, these are all problems I've dealt with my entire career. Let's talk about the trustless problem. Every single thing you do on Wall Street has counterparty risk, everything. And the further you go out on the risk curve, the higher that counterparty risk is. And so when we talk about credit default swaps and you look back at the housing crisis, one of the biggest problems was you didn't know, even if you owned the insurance, you didn't know if the counterparty was going to make good on what you owned. And so there's counterparty risk. Now, once I understood and really I grasped that there's no counterparty risk with Bitcoin, that just blew my mind wide open. I was like, wow, okay, this is something that is truly remarkable, and it's groundbreaking, and it will take our money into something that this world has never seen before. It's an absolute remarkable breakthrough. And yes, it needs technology. Yes, it needs mining. Yes, it needs energy. But, you're storing your energy with money, and that makes sense to me to use a proof of work in order to do that. So it wasn't that big of a leap for me if you think through those terms of the problems I've seen on Wall Street and investing over these years, and how that could be solved so easily with money, true hard money like Bitcoin.
Got it.
I want to caveat one thing that you said, and maybe I just look at this in a weird lens. So I open it to anyone disagreeing with this, but I actually think there is counterparty risk in Bitcoin, but specifically in certain ways that users can interact with it and accidentally introduce it. And the biggest, I think, counterparty risk is not holding your own coins. If I were just to continuously buy and leave it on Coinbase,
Absolutely fair. But you don't own Bitcoin then.
Exactly.
Exactly.
That's
Again,
the key point.
that is a, okay, so I buy a stock, right? And we don't have a mechanism to, this is funny because I was talking to Mark Moss about this over lunch yesterday, and there's no mechanism for you to hold that certificate of stock. You used to be able to, but not anymore. Now you have DTC, and you have prime brokers, or your broker at Robinhood or at E-Trade. They hold the certificate for you. So all you have is an agreement. It's an IOU. Yeah, you've given them money, they're holding it, but you have an IOU. Now the SEC, it's highly regulated. There's the counterparty risk there is pretty low, but 100% agreed that you've just introduced a traditional finance problem that you don't need to introduce with Bitcoin. So get it off exchange, figure out how to do it. It's not that hard. If a 50-year-old guy can figure out in a matter of hours, you can do it. It's not that hard. So
Absolutely.
Yeah.
But
that's a great point, and I'm glad you brought it up because it's a really good point. Yeah.
Yeah, and I think just hammering that home, like, you don't own your Bitcoin unless you own your keys. If you have it on an exchange, you own no Bitcoin. That's something that's really hard for people to wrap their heads around. I was watching I've mentioned this before, but I was watching I forget which old Western it was, with a friend of mine who's, younger than I am. And
everyone's younger than you, P.
That's true. It's true. We've been through this before. I'm a Highlander. I live forever. The point is, there was the whole like narrative arc around like them trying to steal the bond certificates that were in a safe. And he genuinely didn't understand. He's like, it's just a piece of paper. Like, I mean, it's like, can you like go back to the thing and they'll just like cancel the one out? I'm like, that's not how it used to work, man. It used a piece of, like, you had that thing.
You used to walk around with was it Die Hard, where they had the German bearer bonds, and I think it was in Beverly Hills Cop, the same thing, where they had the bearer bonds, where you actually, if you held the certificate, then you could exchange those. Yeah, that's not reality anymore. It's like Swiss bank accounts; they're gone.
Yep. They don't think of the past. Well, I want to shift us to some of the topics that we were hoping to jump into with you today. The first area that I think we'd like to go through is just your thoughts on the general market. So, when you're looking at the market, what are the things that stand out to you, either bullish or bearish, after going through the first 7.5 months or whatever it is of 2022? What are your big takeaways from the market overall?
Well, I mean, you're in a period right now where it's so driven, as much as we don't love it, it's so driven by monetary policy, right? So, and all of the risk assets are truly driven by that policy. How people are, how they're looking at those, and how they're valuing those, right? So what I see is we've had this massive run up in inflation, right? So you can't really you can't look at the general market without looking at macroeconomic cycles and macroeconomic indicators and inputs, right? So right now we have a huge problem with inflation, partially because we printed so much money and we subsidized our citizens with handouts, right? Okay, you just put that where it is. And then we also have supply chain issues because we had shut down the economy. And then as people came out of their homes and started going back out, and they started wanting more goods and services, well, the problem is there weren't the pieces weren't in place yet. Okay, so then you have that problem. People started buying goods Target, Walmart, companies started buying goods and inventory and stocking up ahead of the possibility of yet another lockdown. So nobody knows, and everybody was afraid, and so they didn't want to miss out on this, hugely important last quarter of 2022, which is when retailers make most of their money. So you have that running up prices. Then you have the energy problem, which is a supply issue. We don't have enough supply. We don't have enough refineries to meet demand there. You have the Ukraine situation just exacerbates that. So looking at the market and looking at like everything we're seeing right now, we've had 2 negative GDP prints. Okay. We are seeing consumer confidence come down. We are seeing manufacturing and industrial production is rolling over. Credit card and household debt is rising, along with the delinquencies, right? So people are missing payments. Unemployment you're seeing is rising. Tomorrow's number is going to be interesting. And we're starting to see some softening in the housing market. But the problem is we haven't seen prices come down yet. And so the Fed they have a dual mandate, right? Full employment, low inflation, right? So, but the market reading the Fed's comments, Powell's comments last week, is thinking, oh, they're already turned dovish, and they know that we are in a recession, regardless of what the White House says, regardless of what the Fed says, or Yellen or anybody else. We're in a recession, right? And we are going to have to pause raising rates, and we're not going to be able to do as much QT as fast as quantitative tightening for your listeners as quickly as we want to. So the market, I believe, and this all gets to the answer of your question, is I think the market's gotten ahead of itself, thinking that the Fed's going to pivot really quickly and just stop raising rates, and it has not priced in the probability that they still will raise another 50 basis points, at least another raise, in my mind. Now, that could all change rapidly. If we get an inflation print that's much lower, and we start seeing some other indicators, we get to a really bad unemployment number, meaning bad that people are losing their jobs, not perversely good that for the market that people, but if we see those things, well, then the Fed may pull back. However, it's still driven off of that decision. And I still think that they're going to raise rates again. And so I don't think the market has priced that in. We've heard them say, now you've had all these Fed governors come out in the last few days saying, oh, we're not done yet. We are not done. We need to see significant reduction of inflation, and for a sustained period. So if we have one print that comes down from 9.1 CPI down to 7 or 8, I don't think that's enough. That's not going to convince them. And you've heard them saying that, in the GDP number does not indicate that we're in a recession yet. The problem is, and here we get all the way back to the full circle, is the problem is the Fed is looking at lagging indicators across the board. GDP is such a lagging indicator, right? It takes so long to come up with estimates, and then they're revised constantly until you get the real number, and it's old. So we're seeing housing prices come down, and we're seeing consumer confidence come down, yet we're not seeing consumer prices come down yet. And again, that's sticky because of energy prices. When you have goods that are produced over a number of months that are just now coming to market, well, the price of those goods are the price of what they cost plus the margin. So people are buying, maybe they're buying the same amount of stuff, but they're buying fewer things, right? So they're going down to the necessities. They're getting their gas to get to their job, they're getting their food, and they're paying for their house and their energy. And those are the things that they're focused on right now. And if those are higher, that just means that discretionary goods come down, right? So Walmart and Target are going to sell fewer things that are not necessary, if that makes sense.
Totally. I mean, we saw it out of Walmart's earnings report, sort of the warning that, hey, we fucked this up a little bit, and it's going to get uglier before it starts to get better.
Yeah, they
I
front
want
loaded the inventory, right?
exactly.
So, and they're, yeah.
Well, I have so many now questions off of your response. So forgive me, there might be a little bit of bouncing around here, but I
It's
want
all
to
right.
first start with just your comment about the market's getting ahead of itself. We've
Mhm.
seen the Fed's response, especially over the last 6 months, be in line with what the market has expected. Mind you, the last 6 months have led us into this bear market that may or may not have ended in the short term, at least. Do you like, what is your expectation if the market is getting ahead of itself? What will the reaction be from the market standpoint if the Fed starts making moves that the market otherwise was not expecting?
Well, I think the market may force the Fed's hand, because if the equity market continues to recover, it's such a large part of GDP for the United States. Our financial markets are integrated into our production, right? They're closely integrated into them. So if that continues, then the Fed's going to say, well, it can stomach another. And again, the Fed doesn't really care about the equity markets. They care about the credit markets, right? So the credit markets are not breaking down. High yield spreads are coming down. Why is that? Because they're expecting a Fed pivot. So until high yield spreads and credit markets the liquidity starts to dry up, there's still enough liquidity out there, and the markets are operating efficiently and and effectively. And so the Fed's not worried. The Fed is most worried about, and if you just take them at their word, which I know it's difficult these days, but if you just take them at their word, they are concerned about inflation. And if the unemployment number is not disastrous, inflation continues to be high, that's what they're focused on. So if the market continues to recover, I think it gives them firepower to go ahead and raise again, 1, 2, even 3 times if the market ignores it. Do I think that they're going to do that? No, I think I think that the numbers are going to come in fast enough. Recessionary indicators are going to come in fast enough that they're going to be forced to step back. So, but the pivot to me is a pause. They're going to step back. They're going to pause probably in September, maybe after that meeting, October, before the election. And it's politically driven. We all know it. Before the election, and say we are on target. The economy's good. We have a soft landing, and I think they're just hoping that the numbers don't come in rapidly enough to show that the demand destruction has pushed us into a deep recession, and a recession that they can at least gaslight people about.
Right. If they'll ever come out and actually admit what the definition of a recession is
Exactly.
under this
Exactly.
administration.
No, just change the terms.
Exactly. James, I want to get your sense on this, and we've gone back and forth on this show about what actually, in your opinion, is driving inflation. And of course, this can be driven by 2 parts. It could be a supply side issue, which we have seen some of, given the supply chain issues, shutdowns during COVID, as well as a demand issue, which we're starting to see a lot more of demand as people have been pent up, saving money for years. And it's the demand side of this equation that the Fed, as you mentioned, can actually control and impact with demand destruction. But between these two, there's no clear sign that it's 100% the inflation is driven because of demand. So between the two, sort of, how would you set it? My personal ratio has gone to, it's roughly between 25 to 30% is driven by these supply chain issues, and then the rest of it is really driven by demand. Where do you sort of fall on that scale?
I don't know if I could, if I haven't thought about it in percentage terms, but you just defined and articulated the exact problem that the Fed is facing, right? So they know that there are supply issues. Okay, so what are the supply issues? Well, the biggest driver is energy, right? So as energy prices remain high, remember they were still high over the last couple of months, so prices are not coming down quite yet, in my opinion, right? So, and that the input of energy on all prices of goods. Energy is needed to create and to process and to deliver all these goods, including food. So if you just look at that one major component that has been sticky and has not come down, and it is now, but I'm talking about a lagging indicator, right? So that is the primary driver, and energy is high because of supply. Our refineries are at capacity. We have not incentivized our energy producers to expand. They've had a rough number of years up until this last year, and I've seen a number of them fold their tents, go out of business just because they couldn't keep up with the regulations, with the anti-expansionary policies, right? So now they're being asked to expand, but they're also giving them mixed signals, right? So they're saying we're going to have this one-time tax. We're going to put more regulation around your facilities, and it's just so that is to me the largest impact to the prices that we're seeing in inflation. The second thing is of course, housing has been a massive driver, and they keep adjusting how they're looking at that. So the equivalent housing index that's included in the CPI, it's difficult to say where that really ends up over the next month or two, because we are seeing housing prices come down. But again, I don't even know. I can't put my finger on exactly what they're looking at there. It's hard to see where that survey comes from, and the cities that they're surveying, and it's difficult. But I hope that answers your question.
No, it does. And I want to read you a couple of just numbers that came across my desk in my emails. Household debt has now topped $16 trillion, the highest ever recorded level, driven primarily by auto and home loans. And credit card debt in particular is up 13% year over year, with delinquency is sitting just about 2.7%. So we're not at dangerous levels yet. But this sort of feeds into this idea that inflation has driven us to have to spend more money on the said necessities. We're still seeing sort of this demand a little bit in the housing markets. I mean, who would have thought if you were buying a car in 2020 or earlier, that was actually probably a better investment than buying a share of ExxonMobil if you wanted to sell your car last year. I genuinely actually joked with my dad, we should just go buy a new car right now and then just immediately go and sell it, because somehow that's what the market was dictating. That's obviously not a sustainable model, and we're starting to see this reversion back. I want to get a sense from you, like, this credit bubble has to pop, or at least I believe it has to. But where is it going to pop? Where is sort of that component of it that you're keeping a very, very close eye on?
Yeah, that's a good question. And like you just said, consumer debt is high, but it's not at critical levels yet, right? So it's impacting people, but it's not at critical levels. So if you think about the credit bubble that we experienced back in 2008 and the housing crisis, the problem was people were borrowing massive amounts of on mortgages that were on they were on these instruments that were variable and could be greatly impacted by the rise in interest rates, right? So the problem then is that you had low income or subprime borrowers, okay, not necessarily low income, but just not good borrowers that were taking on credit, that it exploded into this bubble that was forced to pop. They just, once the interest rates went up, the monthly payment doubled, tripled on them. They were toast, right? So, but we don't have that now. So if you talk to the lenders, the difference is people who have taken out mortgages are much, much, much higher credit rating than back in the great financial crisis. So that to me is the main driver. Credit card defaults, they're problematic, but you default on your credit card, and you owe the company money, and you'll work that out through your earnings, or somehow you'll work out some sort of payment plan typically. But it's different than losing houses and having to declare bankruptcy, right? So it goes back to what you're saying. And what's the best way to kill inflation? Inflation, right? People have to stop buying things or cut back on them. And so eventually I think that's where we get to is, people are being nickel and dime to death on subscriptions. You've got your Netflix subscription, you've got your YouTube subscription, you've got your Spotify or Apple Music or whatever it is. And those are the things that will fall away. You're seeing Netflix now, they're talking about taking on advertising. So I think it just forces changes, and people will start peeling off those things and make those hard decisions. And does that mean recession? Yeah, we're in it, and it's not fun. And so, but I don't see, I think that we're going to avoid a major credit bubble, but if the Fed decides to raise rates 3, 4, 5 more times, all bets are off, because all those credit card rates go up by that and a little bit of a multiple, right? So that's where it could be problematic, but I don't see them doing that.
Interesting. I also want to further remind people of this caveat, because so many people are quick to say like, oh, the housing market reads like 2008. There's a stark difference in that in 2007, 2008, people didn't have equity in their homes. People actually had negative equity in their homes. I was having this conversation with my dad last week where he was like, it's weird. It was so easy to get a loan in 2006, 2007, but damn near impossible now. I'm like, yes, Dad, we learned the lessons, thankfully, from 2007.
Exactly.
People have a lot more equity in their homes. If they're forced sellers, at least they're not sort of walking away homeless, hopefully, knock on wood. Hopefully if you've put yourself in a good position. I mean, the repo man coming to take the couch that you bought because you thought you were going to get that raise or whatever, like, not the end of the world. Let me tell you, my girlfriend has a panic attack every time I show her how I want to set up our living room when we move it together.
Yeah.
James, I got one
that's
more.
exactly right. Yeah, that's exactly right. I agree.
I have one more question on this topic before we start flipping over to the next one. But, we brought up Walmart and Target. You brought up how these big box retailers were essentially going and trying to get ahead of what they expected to be higher demand, bought up a whole bunch of inventory. We saw both Walmart and Target kind of get ripped apart during their earnings report, coming out and saying, hey, we forecasted poorly. This is probably not going to be the only bad reading we give you this year. I am a big proponent, and neither company has actually come out and necessarily said there's going to be massive layoffs. But the way I read it is, if a company is not making as much money, you have to cut spending somewhere, somehow. And the highest cost of spending, or the highest sort of overhead cost that Walmart has, is their employee salaries. So is that a fair expectation? Am I being a little too dramatic here? What's your expectation out of that sector in particular? Because that feels like where the real economy, you can get a better pulse on it.
Yeah, no, I think Walmart just announced that they were having layoffs from executives, right? So
honestly, love that though.
It took all my self-control not to hit the like womp 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 womp.
It's absolutely perfectly expectable. So we're seeing that the major tech companies have hired, they've frozen their hiring, right? And just think about Google, Amazon, Apple, like these companies, well, I haven't seen Amazon, so correct me if I'm wrong there, but Apple, these guys are like, okay, we're not hiring right now. Well, think about how large they are and how many people they employ and how much they grow year over year. That's a major it's a major driver, right? So, and they're just the bellwethers for what's going on in the entire industry. So yeah, and that we're going to see that slowdown. And again, we're experiencing this like a slow motion train wreck where you're seeing all these indications, you're seeing all these red flags, yet you've got a Fed who's looking at data that's stale and they're reactionary. And they've said it over and over again. They react to the data, you know. They don't try to predict what's going on. They react to what they see. So, yep, I do think we're going to see more layoffs, and I think the unemployment number is going to rise. I do.
So you have an amazing blog post on your Substack where you go through and define exactly what GDP is, why it's important, what goes into it, how it's calculated, and why we should care about it. Can you take us and the audience through that and explain it to us?
Sure. I mean, you know, the most important thing to know is that the GDP, the gross domestic product of any nation or region entity, is, I mean, it just measures the production of that area, of that nation, right? And so you can measure it as nominal, which is just the straight calculation, or you can include inflation, which is real GDP, and that's the number that we look at. That's the number that we quote. How it's calculated, there are a number of different ways it's calculated, but basically there are three different approaches. There's an expenditure approach, which is kind of the spending approach, the production or output approach, and then there's the income approach. And they're different approaches, but they all should get to the same number theoretically. And so, but what you're doing is you're taking your consumer activity, your government activity and spending, your business investment, and then your net import-export number. So it would be the net exports. And you add those all up and you get your GDP, your gross domestic product of your country. And so what's important about that is that, I mean, that's your country's revenue, right? So when we look at a company, you're thinking, okay, how much debt does this company have? And are they able to service that debt with their revenues and their income, right? So we have our revenues, which is basically our GDP is a broad view of how much revenue we're creating, and the income to the government are, you know, it's basically taxes, right? So, but you can get an idea of how healthy an economy is by their GDP versus how much debt they have. So if you're looking at the world's debt, this is one of the things that you hear a lot of us talking about, is that we have a major problem that the world is, we're so indebted. We're living on a world of credit, right? So currently the world debt to GDP is about 3.5 to 1. So why is that so important? Well, think about it. If you've got debt that's 3.5 to 1, and let's just say that the world debt is averaging about 3% yield, right? 3% coupon. Well, what does the GDP have to be to keep up with that? If it's 3.5 to 1, let's say that GDP is, you know, if we even had average GDP at 2 or 3%, 3 or 4%, it's got to be 3.5 times that in order to keep up with the debt. So the debt is just ballooning. It's getting bigger and bigger and bigger. Okay, it's concentrated in some areas, and some of those regions, some of those countries will fail. Why? Because they won't be able to service their debt. And so you're seeing that going on right now in places like Italy and Greece, right? So they have some of the worst debt to GDP. We can talk about Japan. That's kind of its own beast. But you're seeing what's happening in Italy and Greece. And so one of the things that you're looking at is Well, if their debt is so high and their GDP can't service it, well, what does that do to the EU? Well, the EU steps in and says, oh, we're going to have this new tool. It's called an anti-fragmentation tool. And really all that is they're using yield curve control to make sure that the rates in Italy don't go up so high that they end up just defaulting on their debt. Because as rates go up higher, the short-term rates go up higher. Well, it puts tremendous stress on their banking system. And eventually those banks will fail. And then they'll have to be bailed out by who? By Germany. So that's the problem. And so GDP is so important to see just how much debt your country has versus how much you're producing. And that's becoming a glaring and really serious problem in Europe. It's become a tremendously serious problem in Europe, and they know it. And so that's why Europe, the ECB, just raised rates for the first time in 11 years. And they were negative that whole time. So now they're at zero.
Jesus.
They're at zero interest rates, and they have this problem. What do you think is going to happen? I think, eventually
Wow.
the union has to break up. The writing's on the wall. It's clear. And you're seeing both a flight of capital from Europe into the US dollar because of both yield. The US treasuries give you much more yield than you get in European treasuries and German treasuries even. And there's a flight to safety. You want your money in dollars. You don't want your money in euros if you're a major investor. So for those investors and those institutions that have the leeway to own a certain amount of foreign denominated securities and debt, they'll do as much as they can. And because it's a flight to safety and a flight to yield. So you're seeing that happen there. And you're seeing the same thing happen in Japan. We've talked about that before, where Japan is doing the same thing, and they're just being unabashedly, they're buying their 10-year treasuries and keeping that yield at 25 basis points. They're keeping that yield low in order to keep energizing the economy. The problem is, as you keep that yield artificially low, right, then you have investors looking at yields elsewhere, like the US, and saying, okay, well, I can get a better yield there. And so why am I going to stay here buying, owning these treasuries when the JGB will buy them up, keep the yields low, and I could instead go get 3% in a 10-year treasury in the US. Well, that forces you to sell your yen denominated bond, take your yen, sell those for dollars, and buy the US treasuries. So it puts tremendous pressure on the yen. And so you've seen the yen just spike, meaning it's an inverse quote. So when you see it go up from 120 or 115 up to 137, that's the yield getting weaker. That's the number of the yen getting weaker. That's the number of yen per dollar. So one of the problems with currencies, I wrote something about this too, is that they're quoted in all different ways. So you've got inverse quotes in some of them, like GBP and yen. So yeah, GBP you'll see the GBP quote. You'll see the dollar quoted to GDP or GBPs. Yeah. So it's a different way to look at it.
Can you unpack a little bit? Like, we talk about the debt to GDP ratio a lot. What is its significance? Like, why do people need to actually pay attention to what this is in the context of their own country's fiat currency?
Yeah, and it's just like we were just saying about it's the amount of debt that they have and their ability to service it, right? So Japan's going to run into a problem. So we can just talk about that as an example. Their debt to GDP is over 250%, right? So that means that what's happening in Japan is the Bank of Japan now owns more debt than anyone else in Japan. So they own more of their own debt. They own over 50% of their Japanese denominated government bonds. And so the problem is, Q, is that eventually you'll either default because you cannot make your payments, or there will be a loss in confidence in your currency and in those bonds, and they will sell off, and you'll wind up having you'll eventually wind up having hyperinflation. That's what you're watching out for. So if you're in a place like Lebanon, or you're in Venezuela, and you're watching your GDP and you're watching your bonds, you're looking at clues. Well, where can you find those clues? The first step is obviously knowing what your debt to GDP is, but the biggest clues are in the CDS market. We've talked about this before, the credit default swap market, where you're seeing the investors who actually own those bonds take out insurance on those and pay for insurance on those in case they default. And so you're watching those credit default spreads, and as they go up, then you know that there's more risk. The risk is elevated in the instrument that you own. So you're watching for not just where it is, but is it moving and how rapidly? And so if, there's I think it's World Government Bonds. I put it in a couple of my newsletters. It's called the World Government Bonds. And you can go there, you can see what the sovereign debt is and what the spreads are. But if you go to a place like Turkey, you'll see that their implied probability of default is at 13% right now. Brazil's at 4.5%. Greece is at almost 3%. So these are sovereign bonds. They're supposed to be risk-free, right? They're not risk-free. And so that's where you have to see where your risk are, where your risk lies. And that's a pretty good indicator.
So I think this leads nicely into your explanation of the dollar milkshake theory. You do a remarkable job of distilling it down into its essential components. I would say better than almost anyone else that I've read. I'm hoping you can take us through it and help explain to me and also the audience exactly what it is, why it's relevant, and what it means.
What is that? Which one?
The dollar milkshake.
Oh, the dollar milkshake. Yeah. Well, first let's talk about the fact that this is not my concept. This is Brent Johnson's concept from Santiago Capital, and basically, I had heard it thrown around, and I was like, and I hadn't heard it before until I researched it and looked into it, and it makes perfect sense. We've talked about it on Spaces before, on Twitter Spaces. But basically, the idea is this: it comes from the theory that it's like the action of one landowner extracting oil from a neighboring property by drilling a longer straw, right? So, let's say that Philip, you have a milkshake. Okay, and Q's all the way on the other side of the restaurant, all right, or cafe, right? And your milkshake is basically, it's your currency, and Q wants to drink it, right? So he takes this really long straw, and he's able to take your milkshake and pour it into his own milkshake, right? And in this case, it's the dollar milkshake is, in this case, your milkshake is the foreign currency. The straw is the US dollar denominated liabilities. And the one that's doing the drinking or the other shake that it's going into is the dollar itself, right? So if you look at the US dollar denominated liabilities, US dollar denominated debt, euro dollars, the central bank and major, bank, the liquidity and the interest rate differences, that's what's causing this dollar milkshake. So you're seeing the dollar get stronger and stronger and stronger. And there's a theory that eventually it just swallows all of these other currencies. And the reason is just what I said, is that there's so many liabilities and so many denominations in the dollar that the other currencies get siphoned into it.
So I want to speculate with you if you'll entertain me on this, and if you're like,
Yeah.
no, you're more than welcome to be like, shut the fuck up, you. You talked a little bit about, the impending collapse of Europe. We're talking a lot about the dollar milkshake theory and how slowly but surely each of these fiat currencies will dissolve. What is your expectation for some of these weaker European countries should the Eurozone dissolve? We don't have a euro. Like, what is Greece going to do realistically? Like, what are they able to do given their current situation?
Nothing. No, I mean, first of all, Jeff Ross has said hello, yellow. Those guys are awesome. I love Jeff. He's super smart, doctor turned macro expert. He's one of my favorite guys. So what can they do? Well, I mean, you saw what happened after the great financial crisis, right? They were forced to do austerity, and one of the negative things is that they can take possession of bank accounts, and you saw them do this too. The percentage of bank accounts were just they were taken by the that was a slip of the tongue there, right? So by the Greek government in order to shore up some of those banks and ensure they had liquidity. It's kind of like this extra little tax. So that's one thing they can do. But honestly, what eventually happens is, in my mind, and I don't know when this happens. It could be a few years, it could be a decade, because these things sometimes take a lot longer than people realize. But the European Union breaks up, bottom line, and they're on their own. And so you'll have a reset in regions like in countries like Greece, in Italy. You'll have a financial reset. And they will have pain because their banking systems, their financial systems will grind to a halt, and they'll have to reset their currency and start all over again. Have the Italian lira, and start again. So it will be painful. It's not funny. This is serious. It's a bad deal. So if you're in Italy, if you're in Greece, and you don't have just 1% of your money in net worth in Bitcoin, I don't understand why. You should have some sort of insurance. So they found me, guys. The helicopters are here.
You're speaking too many truth bombs to us. I say this in jest, but in full seriousness. Like, am I going to be able to just buy property in Santorini? Like, is that, we see Italy doing some crazy things to try to draw in some of this money that's leaving the US for Europe for whatever reason. I say it truly in jest, but like, I hope that somehow I can afford to buy maybe half the island of Santorini. Maybe the whole thing, just so that Yellow can't come to the island. I see you in the chat, Yellow. I'm buying Santorini just so you can't come.
Yellow's he's got some good comments here. I'm watching them. No comment. No comment on that one.
To take us back to the serious route, you also bring up Japan, and Dr. Jeff Ross, shout out to giving us this brilliant theory that honestly I'm so on board with, that Japan's hand will be forced as one of the first G7 countries to have to adopt Bitcoin to essentially hedge against their impending doom. Do you like this theory as much as I do? Can we maybe expand on this, talk about what these types of scenarios look like?
Yeah, I mean, look, Japan has a problem where if the yen collapses, like, they're not energy independent. They need to buy their energy. So what are they going to use to buy that, right? So they should, by all means, be adopting Bitcoin right now. They should be buying Bitcoin as much as they can, or gold, or both, truly. But I don't know anything that they're doing any of that. But I don't think that Jeff is wrong. I think that that would be a way out for them. But they'd have to start doing it pretty rapidly. I don't think they have that long to figure this out, because if we go, let's just say we go through this cycle, okay, and the US turns around, does QE again, and then we take on all this debt, they've taken on all this debt, and then it happens again. It happens every however many years, and at some point it just collapses, and so they'll be left with a massive reset. But I do like the idea. So having a reserve that they can bank against, because they're used to be on the gold standard, but if you could go to a Bitcoin standard, man, that would be brilliant for them. Do I see them doing it? No, I don't. I think they're too entrenched in the traditional world, and they think they're going to be able to navigate their way through this. And in this cycle, I think, and I've said it before, I think they're playing a game of chicken with the Fed, and thinking that, well, the Fed's going to have to pivot here soon, and the pain will be over, and we won't have to stand and buy every single bond that comes to market in Japan. The other thing they could do, which is real, is that they could enter a swap market agreement with the U.S. They have a lot of U.S. treasuries, and so they could end up buying treasuries to control our yield, and we could buy Japanese denominated securities to help their yield. That could happen. I don't know anything. Trust me, I don't talk to anybody in the Fed or the Treasury.
If you actually knew, you wouldn't be talking to the two of us right now. That's for sure.
Counterpoint. That's exactly what you would say if you had insider information.
Yeah, exactly. So, but I do agree with Jeff that these guys they're the ones who need it the most right now, and they're the ones who could pull it off. I don't see Europe being able to do it. It's too complicated. But Japan is a single entity that they could pull it off.
Now, we have seen, at least for a short time period, that there's been some movement of money back into U.S. Treasuries, these quote unquote safer assets. Two-part question for you is, do you think it's possible for U.S. Treasuries to go no bid in the near future? And if so, what would the effect be on the overall market if that were to happen?
Oh man, the financial markets would grind to a halt. To go no bid. Well, I mean, sure, if the Fed decides to dump their balance sheet rapidly, and it would just lock up liquidity. But there are a lot of mechanisms they can put forth in order to avoid a liquidity crisis. They could change the balance sheet requirements for banks, the cash and treasury requirements. They've already, back in 2019, we had the repo liquidity crisis that they've already instituted, the ability to step in and ensure liquidity there. So I don't see the treasury market grinding to a halt, at least not this cycle. However, that's exactly what will happen in the future at some point. And that's when, I don't know if it happens in the next 10 years, 30 years, 50 years, but at some point, that's exactly what will happen. And that's what collapses the system, because that's basically what the world reserve is. The world reserve asset at this point is U.S. Treasuries, right? So if you don't have U.S. Treasuries, then every single market grinds to a halt.
Can you take us through what a CDS is?
A credit default swap? Sure. I mean, so a credit default swap is just an agreement. It's like a legal agreement between two parties, right? And so let's say that there are bonds. Let's say that the Italian government bonds out there, and there's one party, one bank will offer a swap, a legal agreement that, hey, if these bonds default, we'll make you whole on that. Okay. So it's just like if your house burns down, okay, you've got insurance on it. You pay that insurance every single month. And if the house burns down, the insurance company makes you whole on it. You get the value of your house. Okay. The agreed to value. It's the same thing. You get the value of par for that swap that you agreed to sign that legal agreement with the other party. Okay. So, and you pay a premium for that. You typically, it's a quarterly premium that it's quoted annually, that you're paying that premium in order to maintain that insurance. Right. So if you see that premium go up, then it means that there is a higher likelihood of default, that the seller of the insurance is they're demanding a higher rate because they see that it's a higher risk of default. Okay. So, but if you look at any credit that has a CDS on it, okay, talk about a company credit. So say you have a credit default swap on GM, right? And you think, well, if the company defaults on this bond that I own, okay, and the capital structure of companies is super complicated. There are ladders of different debt securities and claims on assets. But let's just pretend that you know that your bond would have a claim on assets that would be worth 40 cents on the dollar. Okay. So you can take that credit default swap and divide that amount that you would recover. It's a recovery value. Okay. From the price to determine what the likelihood of default is, right? Because you're not going to zero. It's going to something that you'll get a recovery off of. So you take that price and you divide it by the inverse of that, which would be 60%, and you get your implied default rate. Does that make sense? There's a lot, but I walked through it completely in my newsletter recently.
Which I need to highlight.
Yeah.
I need to tell everyone, if you are not subscribed to James's Substack, you're doing everything about macro research incorrectly. So please do yourself
And your
a
children
favor.
will hate you.
Do yourself a favor and read what this man writes. There's a very in-depth technical explanation. I love to smooth brain this, and my way of approaching it is it's insurance on bonds in the event that the bond just doesn't pay out. And that is the big thing that was, drawn out in 2007, 2008. That was what Michael Berry and all these people were making millions off of. And this is where it gets interesting to me. And I want to bring it back to the very beginning of our conversation when you talked about counterparty risk. There was a huge counterparty risk in 2007, 2008, where there was the possibility that Burry and some of these other investors could just not have gotten paid because the companies that they were buying the insurance from could have in turn, in this contagion, gone out of business and had no money to pay them back.
Correct. Yep.
So, I find it.
But here's the funny thing about, okay, so credit default swaps. Okay, so it would be a credit default swap is like, okay, you have a house and I take out insurance on the house. So you have insurance on the house. I have insurance on the house. Then Philip comes in, he's got insurance on the house. Jeff Ross comes in, he's got insurance. So you've got multiple parties that have insurance, but you're the only one who owns the house. So even if I don't own the bond, I could go get insurance on it, right? So if I'm an institution, I could go out and buy, $100 million worth of credit default insurance on Italian debt. I can do that even though I don't own any, just because I think but I may use that. And here's where it gets interesting for institutional investors, is that I may use that as a proxy hedge to something else that's in my portfolio, that I know that if Italy defaults that this asset that I have is impaired, and so I need to take insurance on Italy in order to protect against that. So that's where it gets pretty intricate in the institutional world. But you're right. It's all it is. It's just insurance on a bond, and that's exactly what happened in the great financial crisis and the housing crisis. And just like you said, there were a number of counterparties that did not get made whole because people went out of business, and the counterparties, they were so snarled up. You didn't know who your counterparty was, and they just disappeared, and they couldn't unwind them and see through exactly who was due to pay, who was on the hook for the liability. So it did happen.
I want to now, if you'll entertain me, unpack the Greg Foss quote that has been spreading like wildfire, especially over the last week, of the idea that Bitcoin is a credit default swap on the Fed. I've tried explaining this to my dad and I can't do it. So I'm really hoping, James, what I can do after this is clip this section of our interview and send it to my dad and be like, does it make sense now? I'm happy to talk step by step through it with you and try to figure out, because what I think some people don't really recognize is the significance of what it actually means to be a credit default swap against something like fiat, against something like our day-to-day dollars, and the significance and importance of that in your investment portfolio, whether or not you believe in Bitcoin in the same way that the hardcore maxis do. From a strictly investment perspective, this hedge now becomes a vital part of every portfolio, in my opinion.
You're right. Yeah. And so, okay, so simplify it, right? So Greg can talk in Greeks and gammas, and like he can get really deep.
I don't want to do that. No.
He's super smart and super passionate. I love Greg. But so the credit default swap on sovereign debt. Okay. So the difference between Bitcoin and sovereign debt, CDSs. So rather than getting like a CDS on Italian debt, well, first of all, individuals can't buy that. You can't just go in and buy a CDS on Italian debt, right? So if you're Italian and Italy falls apart, they collapse. Okay, they go into default and there's a reset. Your euros are basically worth, let's just say that the euro just implodes. Well, there's nothing you can really do about that as far as buying a CDS on Italian debt in order to protect yourself. Okay, we talk about that just to give people an understanding of how institutional investors approach this. But as an individual, you can have Bitcoin in your wallet in order to protect yourself. Okay, you don't have to have all of your net worth in Bitcoin if you just have some. Now, the credit default swap he's talking about it's on a basket of sovereigns. So if you have a number of major sovereigns default, then what do you think is going to happen to Bitcoin? I mean, they're going to go into the money's going to go into the dollar. It's going to, the dollar milkshake will occur to some degree, but it's absolutely going to go into Bitcoin as well. And so as people flee that currency in order to shore up their own, okay? So, but owning Bitcoin is a way to prevent losing all of your money as that currency devolves, right? So if you're in an Italian bank and you have, or let's say it's Japan that's going to fall apart, okay? Craig, let's say Japan falls apart and you have your money in a Japanese bank. Well, if you have US dollars, like how are you going to protect yourself if you don't have ownership of your asset, if it's just a liability at a bank, and if the country falls apart, where's your currency? Or would you rather have gold? So the credit default swap means that It never expires, right? And it's insurance against that currency falling apart, because that currency goes to zero. Bitcoin's not going to zero, it's going up. If the entire world, let's say all fiat currencies default, what do you think is going to happen to Bitcoin? It's going to be worth tens of millions of dollars more, right? Hundreds of millions of dollars in those terms. Of course, everybody in our world would say it'll be worth one Bitcoin. But if you just look at M2 across the world, okay, about $100 trillion, right? So if you look at M2, and Bitcoin is now the market value of Bitcoin is about $400 billion, right? Okay. So if all of the money, all that savings, all that money has to go into an alternative currency, and that's Bitcoin, that's a 250 times, okay? It's 250 times market value what it is today. So if you have 1% of your net worth in Bitcoin, you could have 2.5 times your entire portfolio on the back end of it if everything collapses. If you have zero, all of your cash and anything that you don't have invested in hard assets, it's up, who knows exactly what it's going to be worth. But you will lose anything that you have in cash. It'll be worth zero. Does that make sense?
It almost feels like what we're seeing is, or what we're talking about is the dollar milkshake theory with another milkshake, almost like that meme. And I see all you meme factory.
You're saying
people,
there's a milkshake behind the milkshake.
Exactly. It's like that meme of the guy in the church with the sniper who's like shooting down, but then the two people are down there. And it's like, the US dollar is going to kill this person in front, but really the sniper back there is Bitcoin. And it's like, I don't give a shit. Fine. You want to hide your money in the dollar for like another 2 years? I'm just coming for that eventually.
Wait, we gotta mind this meme. So who's sitting in the front, Peel? Who's in the second? Who's the third? Who's the fourth?
What is the worst fiat currency? Like if someone told you they have their wealth in this fiat, you would literally...
Come on, guys. There's so many out there. I mean,
yeah, but you got to pick one. I mean, like for us,
the worst, the absolute worst fiat. And yes, I know how absurd of a question we are asking you.
Well,
you can't say seashells.
Okay, if we're looking at G20s, I would, you have to look at Turkey. That's a major problem, right? So
fair enough.
But of the ones everybody's talking about, you got to have Japan, and you've got to have the euro in there too. So
all right, so we got Turkey, Greece. Sorry, what was the second one?
Well, but Greece doesn't have a currency. It's the euro, right? So Greece and Italy.
All right, Turkey, Japan, and the euro.
It's euro is it's all or nothing, right? Yeah. So.
All right, so it's Turkey, Japan, euro, US dollar, then Bitcoin.
Then Bitcoin. Bitcoin's the guy behind the guy behind the guy.
I like this. I like this plan. I'm excited. Oh, but of course, we could also just gloriously be wrong, and the powers that be could just, the lizard people can reset the simulation. We can go on back to 2005, and everything will be fine and dandy, right?
No.
I don't understand that question.
There was no question.
That's ridiculous, Q. We all know that the lizard people are real, but there is no reset button. This is the type of simulation where you can't go back without destroying everything. So
no, that's not what the lizard overlords told me in my dream last night. They said we'll go back to 2005 eventually, but only if and when we break everything here so gloriously.
And they're doing a great job.
James, we've covered a host of different topics. We've covered as many things about macro. Is there anything in particular that we haven't really touched on that you'd like us to maybe dive a little bit down? We have about 10 minutes left here.
I do have one.
Yeah.
Go.
Can I jump in with one quick question? Going all the way back to the beginning of the conversation, you talked about your journey into Bitcoin and how part of that was your son, telling you to initially invest in, I think it was like Ethereum and Cardano. And I guess my question is, what would it take for you to let him back into your life now that you've disowned him for steering you so wrong?
He's been steered properly.
All right.
He has moved virtually everything he has into Bitcoin now. So he understands it. He's getting it. So disown it's hard when you have kids, you love them no matter what. So I thank him for truly for getting me back into this space and to explore it. Because without him nudging me and without him telling me, look, you've got to look back into this, I wouldn't have figured it all out as quickly as I did. So I do have to thank him. So I have not disowned him.
I'm disappointed, but I understand the love of, family is important. Please continue. I didn't mean to interrupt.
I did. That's good. No, I think, we've covered quite a bit. I'm going to be interested. I'm really watching these numbers. We've got 2 CPIs. We've got 2 employment numbers coming out. I'm keyed into that. The Fed wants to, as much as they say they're not going to give guidance, they can't help it. They want to give heads up because what the market hates is uncertainty, right? So they think they figured the Fed out last week, and then you hear them today that they haven't really figured them out. So I'm watching and listening to what they have to say, just for clues. But honestly, navigate this carefully. This is a really treacherous environment. One or two major missteps, and we could dive headlong into a deep recession, and it would be ugly. I do think that there's more pain coming. I don't think that we're out of the woods yet, personally. I do think that Bitcoin could grind sideways here for a while, but it's Bitcoin, so it could double overnight. Well, not overnight, but it could. But it's Bitcoin. It could do what it wants. So I would be very careful not to take any of the Fed statements or any of the economic indicators that you see. And most importantly, if your viewers can take anything away from this, don't leverage yourself when buying Bitcoin, especially. God, please do not put Bitcoin itself up as the collateral. That is the absolute most dangerous way to invest, period, is to use a volatile asset as its own collateral to invest in it. That's just, and people don't understand that, but I'm telling you, that's how people get absolutely destroyed. So that's what I would caution you on.
Not financial advice, but seriously, don't stop degen trying to trade and I'll turn my 0.2 Bitcoin into 2. Stop. Enough with this leverage nonsense.
All I'm saying is I have 2 kidneys, and I only need 1.
Yeah, you should sell. You viewers should sell P's kidneys before going on.
No,
leverage.
this is all going wrong.
I have a credit default swap on that.
A credit default swap on P's kidneys. Not kidneys, it's just mine specifically.
I have a theory that I have not mathematically tried to actually calculate, but there is a way to calculate this. But I genuinely, I'm just too lazy.
You say this as if all your theories have like a deep rooting in mathematics.
I mean, so here's my theory that we should have gotten 100K in the price of Bitcoin. However, the thing that actually prevented us was the high amount of leverage in the market, that at a certain price point, the market actually, there is not enough Bitcoin in existence to have filled the successes of all these degen leveraged traders should Bitcoin have reached a certain price threshold. And as a result, the market itself had to forcefully suppress the price of Bitcoin lower. So it's all your fuckers' faults that we didn't get 100K Bitcoin. That's what I'm trying to say.
Got to place the blame somewhere.
Exactly. I know how lame asking speculative questions are, James, but what is your expectation for the CPI read from the month of July?
Oh God.
Like as
Wait, this is
simple as
incredible.
higher or
Wait.
lower.
I literally saw like a single tear just squeeze out of the corner of your eye, and you were like, "I regret every choice that I've made in my life that led to this moment. Never should have come on this show."
Like
Is-
I don't need you
is
to
that-
tell me like 7.8,
Yeah, why do you put our guests through this pain? Yeah, yesterday,
I
whenever it
think
was,
it's
you were
I
like,
think it's gonna be
7.6?
lower. I think it's gonna be lower, but not low enough to stop the Fed from at least raising one more time. But that's my guess. Because they want to see it lower and sustained. So that's my guess. Lower, but not enough. That's my guess.
Okay. I can't wait to invite both you and Jeff Ross back on after the CPI print comes out higher.
Yeah.
Yesterday.
I mean, it could. That's why I'm saying is like, be careful. Seriously, be careful out there.
This is why I take the other side of the coin. I think we're still going to get higher CPI because that 9.1 reading is not month over month. That is a year over year reading. The largest driver of that has been the price of oil. The price of oil from a year ago, July of 2021, was about $75 a barrel. That is a 20 to 25% premium on where we were for the month of July. So that reads to me like, oh, actually, we're still like CPI is such a lagging indicator that we're still a couple months, unless to a lot of people's predictions right now, or at least expectations, we will start to see this decline in the price of oil, which should we get to levels from last year, that's when I think I will start siding with people like yourself and Jeff and saying we're now going to see peak inflation and we're going to start to see these readings come down.
Yeah, but don't forget also you had people coming out of the lockdowns, and so there was more activity, more economic activity a year ago than there was in the previous print. It just keeps going, right? Poor Jeff. Jeff takes so much heat for putting on the bear coat every once in a while. He just takes so much heat.
Just wait for this picture.
Honest,
P unfortunately created an image thanks to DALL-E 2, an AI image generator that has haunted me for the last 2 nights. And let me just say, it's gonna come out online, and I hope it haunts all of you as much as it has.
You're hyping it
me.
up as if it's like a Cronenberg monster. It's literally just
the eyes of this
bear wearing. It's like a doctor that's a bear.
But the eyes, man, the eyes tell you everything. Those eyes look like death.
We can
James,
agree to disagree.
Are you gonna post it or?
No, he's just gonna hype it up until it's like just a fever pitch, and then he's gonna rug everyone, and it's not that amazing an image. I mean, it does have Dr. Jeff's like eyes, like just striking eyes. That's the terrifying part, the human eyes. But other than that, it's just totally normal, grizzly bear in a doctor coat.
I very much look forward to it.
James, when you hear Amsterdam, what comes to your mind?
I'd love to go. I'm actually, I think I'm going to be with Greg and Jeff talking we're going to go to Bulgaria, and we're going to talk there, and then we're going to talk at the UK Bitcoin conference. So yeah, let me know if you guys need another speaker or a panel or something. So just let me know.
Well, you heard it here, George. I know you're listening. McShane, I know you're listening. Do it. The next question I was genuinely about to ask you is, who would you like to see as a speaker at Bitcoin Amsterdam? But you kind of front ran that question with yourself. Nothing
Greg,
but respect.
I'd like to see Greg Aziz on there. Wearing nothing but a potato sack.
James, for our audience who, I don't know, for whatever reason, is not already subscribed to your Substack or following you on Twitter, where can they stay up to date with all the work you're doing and all the research you have cooking up?
Yeah, no, that's obviously I'm on Twitter. And so I'd appreciate that. And you can follow me there. I have things to say most regularly. And then I do you're talking the Substack. For people who don't know what it is, it's a newsletter that comes out every single week on Sunday morning. And I just take one complicated concept and simplify it. simplify it down to for anybody. You don't have to be in finance. You can be in any industry, and it's just made to take away some of that opaqueness and peek behind the curtain of what really goes on and how this stuff comes together and why it's important. So, and I try to make them timely topics that people are thinking about that are front of their mind. So, and then finally, I've been that Substack is also I've made it available to the Bitcoin education platform that I got invited to help out on. And it's called the Looking Glass edu education platform. It's on my Twitter. There's a link to it, and that's an awesome platform these guys have put together. These young guys have put together, and Greg Foss had invited me to help out there. So then you can just sign up there, and you can walk. It's like a course. And it's what is money and why does it matter? What's going on in the world? And it kind of leads you down to why Bitcoin is the solution, but it's great for anybody, any educational level on the Bitcoin space, or in finance. It's awesome. And you can do it through at your leisure. You can decide how much you want to do, how quickly, and it's just like going through a course. And it's awesome. It's free. So definitely. That's it. But thank you guys. I appreciate so much for you having me on and getting to talk with both of you. Awesome questions. And thank you.
This was wonderful, James. I was sad to have missed you the first time when you jumped on Bitcoin Magazine Live, and I appreciate you coming and joining us again. Thank you, guys. I cannot stress enough, if you are not subscribed or following James and the work he does, I highly recommend. Also, if you're not subscribed to the channel down below, please do that. Apparently, they're checking how many subscribers we have now, so I have to be held accountable for my job.
We used to be able to just say whatever the fuck we wanted, but
whoever made these decisions without running a by me, like, come on, guys.
Yeah, I just want to say one more time, James, when we're having these conversations, Q tends to lead the market related, price related. It's just hard for me to care about the price and the macro environment, but your Substack is one of the very few that I read consistently. I really appreciate it. It's very well written, and you dumb it down to the point where even I can understand it.
That's awesome. Thank you. I appreciate that, guys.
Yeah, man.
Good.
All right. Well,
before we cut to a commercial break, I mean, my dumbass went and got a copy of the censorship resistant issue, and I put it on that desk over there, so I can't even show it on camera, but I want to remind all of you watching, the newest edition of the Bitcoin Magazine print edition, censorship resistant issue, is available at the Bitcoin Magazine store, at your local Barnes and Nobles, at a shop in Canada, because I don't live in Canada. I don't know what shop it is off the top of my head, so my bad on that, guys. But you can use the promo code BMLive to get 10% off of that and anything else you see at the Bitcoin Magazine store. I want to shout out someone from Florida just bought a lot of stuff from the Bitcoin Magazine store using promo code BMLive. Heck yes, bro. Thank you. Thank you so much. You just paid Chris's salary for today. So booyah. We'll be back shortly after this commercial break with Jimmy Song, so stick around. You're not going to want to miss it.
Thank you, guys.
You are listening to Bitcoin Magazine Live. Listening to Bitcoin Magazine Live. Number one Bitcoin Magazine Live. You are listening to Bitcoin Magazine Live. Listening to Bitcoin Magazine Live. Number one Bitcoin Magazine Live. Sama.
All right. I stood up during the break and I went and grabbed it just so that you guys can actually see me hold it in my hands. Get your copy today. This is thick, thick. I also want to just
It's
shout
girthy.
out our boy Tommy, the host of Marbles, which may or may not be making a comeback to a Twitch stream near you. Bitcoin War Bonds. I believe the print of this is actually on sale. So hop on over to Young Gucci T's Twitter page where he's posted all of the information on that. Bitcoin War Bonds and his sort of series of artwork on that have been truly incredible. So grab your copy over there. Shamelessly going to plug that just because Tom is the man. So should we do a dramatic reading?
Oh my God. I was terrified you were going to say this. Okay. I can sustain like 15 seconds of dramatic reading and then
I'm gonna do
I'm gonna
the
kill myself.
latest Max Kaiser overdose. Censorship, beep, dematerialization, beep, and Bitcoin. Without freaks, America is nothing. I was originally gonna call this Revenge of Nothingness in a kind of homage to Gabriel Garcia Marquez's magical realism meets Jean-Paul Sartre's existentialism meets Bitcoin. I'll get to that in a minute. But for now, let's talk censorship and the nasty corporate state's heinous, unchecked killing.
Thank you, producer Chris, coming in hot. I was looking for a plastic bag to like put over my head and just choke myself out. You know, I'd see the bright light and then that'd be it. My friends, I think Jimmy Song is not going to be able to join us, unfortunately. I apologize for all the women that were induced into labor by Q's rendition, the people that were driven insane. It can have that effect on people, but we love all of you. We will see you tomorrow. We'll be back here delivering the news, talking shit, and doing what we do best. See you then.